Hi, I created some additional information, four additional videos here for you, based on some of the comments that I had during session one, and to help clarify some of the things that we went over in point and figure charting. I really do want to make sure that you get this information as clearly as possible, and so that there's not a lot of confusion there, because that doesn't help you, and frankly, I would feel like I would be missing the mark if it's not clear to everyone. Okay, so what I want to cover, I've got four separate videos that you're going to find in your members area for point and figure charting. And so the first thing I want to go over is why we use intraday swings versus daily highs and lows to build point and figure charts. Seemed to be a lot of confusion about this. Are we using a daily chart to construct a 1 point? Is that a 1 point figure chart? Or why are you using 60-minute and so on and so forth? So I want to make sure that you're clear on this. And so I put a video together to explain why, and I'll show you exactly why we will use data from an hourly chart and capturing the hourly swings, and how that's much more accurate and much more effective in doing point and figure charting than if we just relied on daily highs and lows. You can certainly do that, but as you're going to see, the accuracy, the extent of the horizontal formations and the accuracy and the projections just aren't there when you use daily highs and lows. Okay, so that's the first video, and I would encourage you to watch it if you're at all confused with that. Second video is I'm going to walk through constructing a point and figure chart, starting show you exactly how it's done, day by day for over a month's worth of data, and we're going to use a stock in this. We're going to construct a 1 point figure chart. That's a 1 point box size with a 1 point reversal, the standard Wyckoff point and figure chart. And I'll show you as we look at the data coming in. We're not even going to look at charts, because I guess I confused you on that, and I didn't mean to do that for some of you. So we're just going to look at the swing data off of the hourly swings, and I'm going to plot that as figures on a 1 point figure chart, and you'll see exactly how it's done. And there should be no more confusion or questions about how you construct a point and figure chart and why you do the things that you do. Okay. Third video I have done here, excuse me, is a video on the Wyckoff terms and concepts. I understand that there are a number of people here who are not as familiar or maybe not as skilled in the Wyckoff approach to the markets as some other folks are. Some folks in here are experts. So I want to, in the Wyckoff method, so I want to just, for those folks who are not that familiar with Wyckoff, and even if you are familiar, it wouldn't probably hurt you to review this video. But I'm going to go over the terms that we use, which I think that, especially for you who are not, for those of you who are not that familiar with Wyckoff, when I go through the terms, you're going to see that these really most of them relate to assessing supply and demand in the market, and that is a vital ability and skill in trading that I think you're going to want to try to acquire. So we'll look at things like shortening of the thrust. We'll talk about hypodermics. We'll look at the Wyckoff story, springs and upthrusts, testing, signs of strength, signs of weakness, those kinds of terms and concepts that we talked about in session one, and we're going to continue to talk about in session two. And hopefully I'll give you some better definitions of them than I did in session one, and add some flesh, so to speak, to the skeleton that we created in session one. And then finally, a couple of people said, well, how does this apply to intraday trading? How do you do point and figure charts with intraday trading? So I've looked at the last week of the S&P E-mini, and that's the ES symbol, and I've shown you how to use point and figure charts on the intraday time frame. As if we were day trading the S&Ps, what we would be looking for, how we would be assessing that market as the point and figure chart evolved, and where we would take counts, where we might take trades, and also, by the way, showing you two things. One, that the same principles that we used in the Apple chart, working through Apple for two years or so, the exact same principles, the exact same techniques, the exact same method is applied to the intraday chart. You're going to see that they are identical. In fact, there are no change. There's no additional stuff that occurs because we're trading intraday rather than swing trading, or there's no additional stuff in swing trading when we're compared to intraday trading. Stuff meaning technique or method. They're identical, and you'll see that. The second thing I want to point out is that the Wyckoff terms and concepts, I go into a little more detail, perhaps, on the intraday S&P chart, showing you things like shortening of the thrust and talking a little bit more about the Wyckoff story and what that means. People were thinking, some folks had said that, boy, these point and figure chart counts can be really subjective. Well, yeah, they can be if you're just doing it willy-nilly and not having any kind of method to your approach. You have to have a process and a method, and that is all about building a Wyckoff story. So I show you how to do that in a couple of instances in the intraday trading with point and figure charts, not just in taking trades but also getting out of them as well. I think all of this kind of hangs together, and I hope that you're going to find this material both clarifying and of value. If you have questions, of course, as I said in session 1, send them to me by Sunday noon time, Eastern time. And send me any comments that you have on these additional materials or on session 1. I'm keenly interested to hear your comments, and I'm keenly interested in trying to convey this material as accurately and as clearly as I possibly can, because it's really good stuff, really good material. And I also want to thank Rama for taking the time and sending Helen and I quite a detailed email about session 1, and in fact, all of this material, these additional charts here, the 4 additional videos, are all coming from comments that Rama had. So Rama, thank you very much for doing that. It certainly helps me in conveying this information. And I'm sure that everybody out there who is a co-member of this course with you are appreciative of that as well. And I'm sure that they would thank you. But I certainly thank you. Okay, everybody, enjoy these next 4 videos, and I will see you Tuesday night at session 2. Hi, I wanted to just go over a few Wyckoff terms and concepts that were raised in session 1. People, there are several people in this subscribing to this video who are not that familiar with Wyckoff, so I thought it'd be useful to go over some of the common terms and concepts that we use and that I may have mentioned in the first session, so that you are clear on what these are. All right, so let's get to it. Shortening of the thrust. We certainly mentioned this. As the market moves either up or down, the length of its swings or thrusts begin to diminish. this is what we're looking for. We're always measuring the length of the swings or the thrusts, if you will, in a market movement. So if we're moving up, for example, and we have a move up that's 10 points long, and then then we have a reaction, then we have another thrust up, but this time it's only 7 points. We have a reaction, and then we have another push up, another swing up, and this time it's only 3 points. Well, that's shortening of the thrusts, okay? And it indicates that the trend is tiring, and the trend can be going either up or it can be coming down. If we're coming down and we fall 9 points, we have a little rally, then we fall again. 6 points, we have a rally, and then we fall only 2 points. Well, that's diminishing thrusts down. It's shortening of the thrust to the downside. And it indicates that the trend is tiring and could very well be coming to an end in the very near future. Okay? So that's shortening of the thrust. Hypodermics. I mentioned this. Now, this only occurs in an uptrend, not in a downtrend. So at the end of an uptrend, or even sometimes we see it in lesser advances, a small rally, we'll see a swift and sudden drive up in price, but it's quickly retraced. Now, often it occurs in resistance, but it doesn't have to. It can be into new high ground. Either way, it's designed to attract late buyers and really weak buyers, people who have been sitting on the sidelines and suddenly see the market go up and they say, oh, I've been sitting here on the sideline, I've been missing all these profits, I've got to get in. It's designed to attract those kinds of buyers right at the top of the market. And then they get locked in because the market swiftly reacts. So Wyckoff, where does hypodermics come in? Well, Wyckoff himself tried to give a little bit of a descriptive analogy, so to speak, and he likened hypodermics, or likened these moves, I should say, to a dying patient who's lying on the operating table, and the doctors are all standing around, wringing their hands, not sure what to do, and somebody has the bright idea to give the patient a shot of amphetamine, an injection of amphetamine. Amphetamine is a very strong stimulant, and that revives the patient. And, suddenly his vital signs look, he's got a strong heartbeat, and his pulse is good, and so on and so forth. But it's only temporary, because this patient, once the drug wears off, the patient reverts back to his original condition, and that's hypodermics. It's the same thing in the market. Once that stimulant, that swift drive up, has had its effect and brings the late buyers in, the market naturally reacts and retraces all of that hypodermic move up. And so that hypodermics is only temporary. The swift move up, the bullishness seen in the market is only temporary. All right, springs. This is a very common event in the markets. It's one of my bread and butter trades. I like it very much. So a market makes a swing low. It then rallies, and I like to see a good strong rally, maybe breaking any downtrend line that exists. And then we come back to the swing low. We don't hold a higher low, or just meet it and make what's commonly referred to as a double bottom, but the market actually goes underneath the low of that last swing, the initial swing low. But it doesn't stay there. It falls underneath. Maybe it goes under for a bar, maybe a couple, 3 bars, and then turns right around, doesn't go deep below, but penetrates only slightly, and then turns around and closes back up above that original swing low. This is a very bullish indication in the markets, because it indicates that we brought the market back down and in effect kind of called out the sellers, said, come on and show us your hand, by bringing the market down below the last low, the last swing low. But sellers don't come out. And so buyers see this, they step in and strongly push the market back up, closing it back up above the last swing low. That's known as a spring. The upthrust is basically the opposite of a spring. We've been moving up, the market's been advancing and makes a swing high, then it reacts, and I like to see a strong reaction. Kind of a sign of strength, a sign of weakness, if you will. We're going to talk about that in a moment. On that reaction, but then returns back up to the swing high and trades over it, but just briefly, a bar, 2 bars, 3 bars maybe, and it's unable to continue higher. Instead, it falls back down through and closes underneath that original swing low. So it's a mirror of the spring, and the upthrust is a bearish indication. In both instances, spring and upthrust, what the key idea here is failure to follow through. In the case of a spring, we are driving back down again or pushing back down again below the low, below the last low, and the market can't continue to go down. There's no follow through to the downside. In the case of an upthrust, the market rises above the last swing high, but fails to follow through to the upside. Sometimes these are referred to in the technical literature as false breakouts, and you can think about them that way. We don't look at them as false breakouts because that takes the idea of supply and demand right out of the definition. What we're looking for is a failure to follow through, indicating that in the case of a spring, selling is not able to drive the market down, therefore it's gone from the market at that point and buyers are stepping in. And then in the case of an upthrust, buyers are no longer present in the market and sellers are stepping in. Okay? We always want to be looking at supply and demand, not just the big problem with traders in general. And in my judgment, one of the main reasons why so many traders are not successful is they take these concepts of breakouts and they're not thinking about what's happening in the market. They're just looking at that one indication. Well, the market breaks out or fails to break out and then comes back underneath. We're looking at it in terms of supply and demand. That's what moves the markets. Nothing else moves the markets. Even news reports are going to be driven. There's an underlying factor of either supply or demand that is supporting that news event, and so we always relate back to supply and demand, and that's important, and that's how we define springs and upthrusts in the terms of supply and demand. Okay, halfway point. Excuse me. It's the halfway between we refer to this a lot in point and figure charting. The halfway mark between the high and the low of a significant swing. Okay, so the market can retrace up to halfway back from its higher low, and the trend remains intact. That's an important concept. More than this, and it suggests that the trend is weakening. Less suggests the trend is strong. Okay, so for example, let's say we have a strong move up, and then we start pulling back. Well, we mark the halfway point between the high and the low, and we see what the market does. If it comes back to the halfway point, fine. As long as it stays and doesn't go much under that, the strength of that move remains intact, and we would expect continuation or follow through to the upside. If we come deeper than halfway back, then that indicates that is not so strong, that move is not so strong, and that the market may actually be weaker. And so we start looking for signs of weakness. If it comes less than halfway back, it suggests the trend is strong, and we would expect to see a good drive out from that level. So if you think about the halfway points, what we're really measuring is the opposite of what's occurring in the market. If we have a strong move up, then we have demand coming in, right? The halfway point tells us if supply is getting stronger or not. If we go above or to the halfway point, on the point and figure chart, it suggests that selling or supply is not that powerful, and so we would expect demand to resume. If it goes deeper than halfway, well, demand may not be as strong, and so we have to check our idea that demand is in control of the market. So frequently a measure in point and figure charting, and although I've talked about up moves here, it's the same thing with a down move. The market can move down, and then it has the right, so to speak, to rally back up halfway between the last high and low. And as long as it doesn't go much beyond that halfway point, that down move should be intact, and we would expect supply to resume its course and push the market down for a lower low. And as I say, it's a frequent measurement in point and figure charting, and it's a great way to just monitor the markets. How are they moving deeper than the halfway point, above it, right to it, and that gives us just another indication about the supply and demand equation or picture in the market. Okay. All right, tests. We talked about this in the session. Tests are a little bit different perhaps than you've heard before. Maybe not, but I want to go through them. After a market holds support, we will frequently see the market rally up a bit. Not making a new high necessarily, but rally just the same, and then return to support, either coming all the way back down to it, or frequently we see it hold a higher low not far from support. Now that's sort of the picture that we see, and the concept behind it is that the market is testing for supply. And if it doesn't find any supply or selling down there, the market will turn back up and rally higher, usually pretty aggressively. Okay, so let's go through this a little bit more detail. So for example, the market comes down, makes a swing low, and then we see a rally. We'd like to see that rally be pretty robust and strong. And then we'd like to see the market pull back. And on that pullback, we expect to see a weak pullback if we're looking for a test. Okay, and that test will look like on a vertical line chart, the price bar and volume chart. It will have smaller ranges, the difference between the high and the low, smaller ranges on the pullback than the ranges that we saw on the drive up. And volume should start to recede, particularly as we get down, as we go down in that reaction, in that pullback. So smaller price bars, smaller volume, and it can go all the way back to the support, or more frequently it will hold at a higher level than support. And because we see the support holding there, that low holding there, higher low or support, and not follow, again, we have this idea of following through to the downside. It's as if we are disconfirming the presence of supply or selling by seeing the market pull back, almost as if it's encouraging the sellers to come out, saying, okay, now we're coming down. So if there are sellers in the market, we would expect them to start jumping on board and driving the market down lower if the market really is laden with sellers, if the sellers are still dominant in the market. When we don't see that, and we see the light volume and the narrow spreads, or only one or two figures on the point and figure chart, and then the market starts to push back up, we know that that's a test. And often this is a good spot for a trade to be initiated. Because it indicates not only that support is strong, but it's also and held, but it's also been tested as well, disconfirming the presence of supply. Often support will bounce off of support only to come back down through support. I'm sure that's happened to everyone listening to this video. And the test is a way to help us prevent that. Okay. Now, tests don't just occur at support, they also occur at resistance. Again, it's kind of a mirror of the testing at support. Sometimes we might refer to this, like for example, Tom Williams will call this a no demand. but Wyckoff would have called it a test. They're equivalent. So the market holds resistance. In other words, the market comes up to resistance, finds supply coming in, right? And then reacts. And we'd like to see that reaction be pretty strong. Then we have a weak rally back up, and it either goes a little below the resistance, which is actually an indication of greater weakness, or sometimes it goes right up to the resistance level. But again, we'll see on a vertical line chart, narrow spreads, light volume. On the point and figure, it'll be one or two figures that occur. And again, just like with support and testing of supply, selling, now we're testing demand. Okay? So it comes up to or a little underneath resistance, checking for demand, disconfirming the presence of demand, because as we all know, when the market starts to rally up again, oftentimes we'll see buyers come in and start to see it get marked up. But if they don't come in, then we see it as a test. And again, just as with support, this is often a good spot to initiate a short trade. Now, both springs and upthrusts are also frequently tested. Think about this. On a spring, if the price goes below support, doesn't find sellers, rallies up a little bit, then comes back down and tests that once more, it's like a double confirmation of no supply. That's a very strong indication and often a good buy point. Now, that doesn't always happen, I have to say. Frequently we'll see tests, but just as frequently, I think, and maybe even more so, the market will rocket off of a spring and drive straight up. Often that has to do with the volatility. If the volatility is expanded in the market, then frequently we don't see springs tested. And same thing with upthrusts. Upthrusts are frequently tested as well. We'll see the market make a new high. We go up above that for a bar, 2 or 3, then we come back down, and then we have a weak rally up, not going all the way back up to the top of the upthrust, but either to the resistance, the original resistance level, or just underneath of it. And that's often a great spot for a solid spot to initiate a short trade. High odds at that point, again, because sort of a double test of failing to follow through and then testing for demand. Okay, demand and supply lines. These are the areas or the lines in a trend where buying, otherwise known as demand, or selling, otherwise known as supply, has come into the market. Okay, in trends where we can establish a trend channel, the upper trend line is referred to as a supply line and the lower is referred to as the demand line. Sometimes we, in the Wyckoff literature, will see it as described as a support line. So let's say we are in an uptrend and we make a higher high and then a higher low and then another higher high, and we come back and we're looking for the market to hold at the trend line, at the lower trend line. This is called, more descriptively, the demand line. We expect demand to come in at that point. Same thing in the supply line. Even in an uptrend, we are, well, let's do the downtrend first. In a downtrend, we make a low, then a higher low, a lower high, excuse me. We make a low, then a lower high, and a low, and now we've established a downtrend. We've established our supply line, our trend line, trend channel. So we expect supply to come in at that trend channel line. Well, we just called it the supply line to be a little bit more descriptive. Now, in an uptrend, we also have demand and supply lines. The demand line is pretty obvious, but as the market moves up, makes a high, supply comes in at that point, right? And then we have a reaction, a little pullback, demand comes in, we rally up to a new high, and often that's right at the upper trend line in a trend channel. Well, that's our supply line there too. We expect supply to enter the market because the market is getting overbought in the trend channel at that point. Okay? So that's demand and supply lines. Fairly straightforward. Danger point. What are we looking at here? This is the price area or level that tells us that our trade is on the wrong side of the market. And if the trade is going against us, we exit with a minimal loss. Okay. So, for example, let's say we're selling the supply line in a downtrend. So we're selling near the danger point. The supply line becomes our danger point. Okay. If the market turns around and rallies and closes above the supply line, well, we know the trade is in trouble. So we know the trade is wrong. So we exit there and we take only a minimal loss. All right. When we take trades at or near the danger point, which is generally where we want to initiate trades, it's the risk is going to be low. So it's always the preferred entry location. If we're taking a breakout trade, for example, we're not really buying or selling near the danger point. It's pretty far away, so we have to place our stop at the halfway point between the low and the high of that swing as we take the trade near the high of that swing if we're taking a long trade. So we have to place our stop halfway down. That's going to be larger usually than a stop placed right near the danger point. So, for example, if we're in a trading range and we have horizontal supply and demand lines, we might take a trade at support and we have our stop right down below support, and we know that if the market turns on us and closes below support, the trade's in trouble, so we exit, but we get a chance to exit near the danger point where the risk is low. So that's the idea of the danger point. Basically, there's two concepts. That's where we want to try to initiate trades, and that's where our risk is going to be the smallest in general. Okay? Signs of strength and signs of weakness. SOS, SOW. When the market's been in a trading range or in a downtrend, for example, and then we see it rally strongly, and we're going to see on the vertical line chart the wide price spread, wide spread in the price bars or the ranges, closing near its highs and with increasing volume on the rally, then we note this as a sign of strength, and we expect demand to continue to drive the market higher. And the sign of weakness is just the reverse of a sign of strength. When we're in an uptrend and we see the market move on the point and figure chart, we see the market move in a straight line up, that's a sign of strength, right? And then we expect that demand to continue, which will be confirmed by what? A move down to or above the halfway point, and kind of a choppy move, not a straight down move, but one that shows a little more, if we were looking at a vertical line chart, a lot of price bar overlap rather than a swift move down. Okay, and then the reverse is the case for a sign of weakness. If the market falls in a straight line down on a point and figure chart, we would view that most likely as a potential sign of weakness, and then we want confirmation on the next rally or pullback. Okay, so that's signs of strength and signs of weakness. Wyckoff story. This is probably the most important concept in the Wyckoff, in the modern use of the Wyckoff method. Interestingly, if you look through Wyckoff's materials, you can see it there, but it never was explicit. He never says this is the story of the market or this is the Wyckoff story. But that was later developed by David Weiss, who is a great Wyckoff trader. And so I borrowed the concept from David, who was my mentor, is my mentor still, and I'm still a student of his. Although not formally these days, but we're good friends and have a lot of respect for David. He taught me the Wyckoff method, so I would encourage you to look at his materials too, particularly his book on his most recent book. called trades about to happen. Okay, so trades with the best odds of working out. If we're taking a long trade, the ones that are going to produce, see the market continue in the direction to the upside. Or if we're taking a short trade, those trades that we see the market continue to move to the downside. The trades with the best odds are not those that have only a single indication, such as an action on an indicator. And here's where I believe, traders have great difficulty. They read in a trading book that's, if the indicator does this and if price action does that, then we want to take this trade, right? Well, that's a very simplistic way to look at the market from the way that we look at the market. We don't do it that way. We're not basing our trading actions or our ability to read the charts on one or two indications. We are keenly interested in supply and demand. And as you will see if you get into this method, if you study this method, markets rarely turn without signaling what they're going to do. Occasionally that happens. There's nothing that's 100%, but most of the time, V-spike reversals is a market that turns on a dime, so to speak, right? That occurs maybe 10 to 15% of the time in the market. So why focus on that? Focus on the 85 to 90% of the times that the market turns. And when it does that, it's going to show us multiple indications that changes in the supply and demand are occurring. And it's these multiple indications that form the basis of a Wyckoff story. We don't just take things on one indication. We're looking at multiple indications, several indications that supply and demand is changing. And it's these multiple indications, or the Wyckoff story, that creates the opportunity for a high odds trade. So, for example, a market may be trending down, and we start to see shortening of the down thrusts, right? Maybe we've moved from 10 points, then the next swing down or thrust down is 7 points, and now we see another thrust down is only 3 points. Okay, so we have shortening of the thrust. Then we see a rally come, and that breaks the downtrend line. We have a strong rally now that occurs. Okay, there's a second indication. So we have shortening of the down thrust and a strong rally. And then the pullback off of that rally is fairly choppy and weak, and it tests the last swing low on lighter volume if we're looking at the vertical line chart, and maybe it's holding a higher low. Well, those are additional indications that selling has dried up in the market and buying is starting to take control. Okay. Now, we'd also be looking at the point and figure chart to make sure that the last down count has been satisfied. We went through that extensively in the first session. And also whether there's a sufficient count to make the upside worthwhile. Remember, the point and figure charts serve as a way to protect us from ourselves sometimes. We want to jump into the market, and we don't want to do that if there's not a good count. If we're using point and figure charts to make our getting into the market worthwhile. So if those conditions are met, then we may enter a trade in that case. So the Wyckoff story is all about reading supply and demand, and it's all about seeing numerous things, several things occurring that indicate that supply is drying up and demand is starting to take control, or that the buying is losing its impact. We're seeing less and less demand to the upside, and supply is getting stronger, and we're just looking for an opportunity now. If we have a decent count to the downside, we're looking for an opportunity to go short. Okay, so that's the terms. I'm pretty sure that covers all of the terms that I've gone over in session 1. If not, I will add to this, and if I bring up other terms in session 2, which may happen, we will add to this. We'll make an amended video for this. But this should get you started, particularly for those folks who are not familiar with the Wyckoff method. And even for those folks who are familiar, maybe you were a little fuzzy or a little cloudy on a given term or two, and hopefully this will help set you straight. Okay, that's good. Thank you. I'd like to clarify how to build a point and figure chart used in the Wyckoff method. Now, I know there's other point and figure chart methods that others have developed, but we're not interested in those, only in the traditional Wyckoff approach. So we'll be building figure by figure a 1-point figure chart. And you'll recall that a 1-point figure chart has a 1-point box size and a 1-point reversal. That'll become abundantly clear as we do the work in this segment here, build the chart in this segment. We're going to be using the recent 60-minute data from Caterpillar. Caterpillar is a New York Stock Exchange listed stock. It's also on the Dow 30, part of the Dow Industrials, and part of the S&P 500 index. So it's a liquid stock. It's actively traded. It's a good trading vehicle, and it's a good stock to show how to chart out a 1-point figure chart. Okay, so let's get started. You can see that on the left-hand side, I have transferred the hourly price swings from the 60-minute chart shown above onto this chart. And then on the right-hand side, we have space to create our point and figure chart. So let's begin. Our first set of data shows hourly price swings from 66.10 down to 63.61, and then back on up to 64.60. So we're just going to start in as if there's nothing else on the chart, which there isn't. For our purposes, we start at 66. So we plot a figure at 66. Now, obviously, the data shows 66.10, but we are only interested in the full figures, the full 1-point figure. So the 10 cents doesn't, we don't chart that. It doesn't matter to us, okay? The market goes from 66 down to 63.60, so it has to pass through 65 and also 64. Now, even though it goes to 63.61, it doesn't go through 63. It's a 1-point figure chart. All we're interested in is the full figures. And so we stop at 64 because 63.66 is larger than 63. Therefore, we cannot plot a figure in the 63 box. Likewise, the market goes from 63.61 and swings up to 64.60, but we're already at 64, so we can't plot any higher than that. We can't go up to 65 because the market didn't go to 65. So that's where we stop our point and figure charting for the day. The next couple of days show a swing down to 63.10. Again, we are not penetrating 63 or meeting 63, so we're above it at 63.10, so we don't do anything to the downside. However, the market rallies up to 72.71. That means that we are going to move up because we go through 65, 6, 7, 8, 9, all the way up to 72. Now, we already have a figure at 65, so we can't go through it. We have to go around it, and that means that we start a new column. So we plot a figure at 65, and one at 66, and another one at 67, and 68, and 69, and 70, and 71, and 72. A nice move up, right? We don't, even though it's 72.71, it's more than, say, 50, it's more than 72.5. We still didn't break 73 or meet 73. Therefore, we stop at 72. Okay. All right. Our next set of hourly price swings on the next day, we go from 72. We have a little bit of a reaction. We go down to 69.15. That means, again, we can't go through 71 because we already have a figure plotted there. So we create a new column, and we come down 71 to 70, and nope, we don't go to 69 because 69.15 is larger than 69 figure. We didn't penetrate or reach 69 even, so we stop there. So notice that the market in its actual price movement went from 69.15 back up to 70.71. Well, we're already at 70. It didn't reach or exceed 71, so therefore we stop at 70. Our next day's set of swing data shows the market coming down to 69, but we are already 69.85. We don't penetrate 69. We're already at 70, so we don't do anything. However, the market does rally up off of the low of 69.85 and goes to 72.49. Therefore, we've already got a figure at 71, so we start a new column. And we go up 71 and back up to 72. The market does go a little higher to 49, but it doesn't reach or exceed 73, so we stop at 72 for the day. The next day, the market falls back to 70.86. That means that we come down through 71. We have a figure there already, so we start a new column. So we go to 71, and then the market rallies up to 71.53. We didn't meet or exceed 72, so we stay at 71 for the day. We only paint one figure in for that day. Next day, the market comes down to 69.26. So it goes through 70, but it doesn't go through or reach 69. It stays higher at 69.26. Then it goes back up to 71.03. That's enough to that's enough to create a full figure. We've already got a figure at 71, so we create a new column and we stop for the day. Next day is kind of a repeat. We drop back down to 69.57. So, whoops, we can put a figure in at 70. Can't do it at 69 because we didn't reach or exceed it. But then we push back up to 71.06. We already have a figure there, so we create a new column, and that's the figure charting for that day. The next day, kind of another wash and repeat, we come back down to 69.76. So we would plot a 0 here, and then it goes back up to 70.92. Well, we're already at 70. We didn't reach 71, so we can't start a new column going up. Okay, so we only plot that one figure for that day. The next day comes down to 69.11. We're already at 70. We didn't reach 69, so we don't plot anything there. The market rallies back up to 69.99, obviously a narrow range day. We didn't get to 71. We're still stuck here at 70. So actually no figures get plotted for that day. Now, on the 11th day, we come down to 68.51. Finally, we get to plot a figure in the 69 level. Then it goes back on up to 71, breaking 71 to go to 71.19. We already have a figure in 70. We have to go through that, so we create a new column, 70 and 71. And then we stop for the day. On the next day, the market returns to the 69.65 level, so we come back down through 70, and we create a new column because there's already a figure there. Then we can't go down further to come back to 69 because 69.65 is higher than 69. But the market does go back up to 71.90, so we can add an X in our 71 slot. And that's it for the day on that day. The next day, the market falls down to 67.81. Has a pretty interesting day here. So it has to go through 70. We have a figure there, so we start a new column. 70, 71, I'm sorry, 69, 70, 69, and 68. Now notice that 67.81 is doesn't allow us to go and put in a figure in the 67 column. But we do put one in on 68. Now the market rallies up to 72.83. We already have, so now we need to go up, but we already have a figure in 69, so we start a new column. And it goes through 69, 70, 71, and 72. The market goes up to 72.83, but it does not reach or exceed 73, so we stop at 72. And then the market has another swing down to 70. And so we create 70.07. So we can go one figure, 71. We can't go all the way to 70 because 70.01 is larger than 70. And that's it for that day. The next day sees the market push up from the 71 level to 72.43. And so we put an X up there. Then it falls back to 71.08. And we again come and put, oh no, I'm sorry, 71.08. Yeah, no, we can't do that, can we? So we are at 72. And that's it for that day. Now, the next day, now we can put some more data in. The next day, the market slides down to 68.34. And we were at 72, so we have a figure at 71, so we start a new column. And 71, 70, 69, and we stop there, right? We can't go all the way to 68 because 68.34 is larger than 68. Then we go to 71.09, so we start a new column because there's already a figure in 70, so we go to 70 and 71.09. We penetrate 71, so we put a figure in 71. And then we fall back to 70.24, but that's not enough to get us down to the full figure of 70 because it doesn't reach or exceed 70. It stops at 70.24. So we stop there for the day. The next day, we see the market rallies up to 72. We were at 71. We had stopped at 71 because we couldn't go down to 70. So we can put we continue that column by putting in another X at 72. The market then falls back to 70.55, so we come back to 71. We can't go all the way down to 70 because 70.55 is larger than 70. And then the market rallies up to 71.34, but that doesn't mean much for us on our point and figure chart because we can't push up to 72. It's not enough. So we stay here at 71 for the day. Oops. The next couple of days now show the market starting off at 71.63, and we are already at 71, so we can't do anything there, can't go down or up. Then it rallies to 75.32. And so we can go to 72, 73, 74, and 75. And then the market ends at 75.70. Seems like there should be a pullback there. Let me check the data here. Hang on. I think I just transposed these. It went up to 75.70 and then came back to 75.32. Going up to 75.70 still doesn't get us up to 76. So our point and figure chart is okay the way it is. And ending at 75.32, we didn't get down to 74, so we stay here at 75. The next day, the market rallies a little bit higher. It goes to 75.93, but that's not enough to reach 76. So we can't go up, and then the market falls back to 74.33, but that's not a full figure. We need to go to 74 or lower to be able to paint a zero here. So we just stay. We don't add anything to the figure chart on this day. The next day, again, we rally up to 75.56, but once again, we're already at 75. We didn't go a full figure here, so we can't go up. However, the market starts to fall down a little bit and goes to 73.21. Now we can start to add some figures to our point and figure chart. We already have 74 in our column, so we start a new column, 74. What's the low here? 73.21. So we stop there because we didn't get the full figure down to 73. And then it rallies up to 74.53. And again, we stop here at 74 because we didn't move a full figure. So that's it for the point and figure chart for that day. The next day, we're at 74. I'm sorry. Excuse me. Hang on a second. Okay, that just didn't shade in there. The next day, we've been at 74. The market falls to 72.33, so we can come down one full figure, but not more than that because 72.33 is higher than 72. But we come down the full figure of 73. Then the market pushes back up to 73.84, but that, again, is not a full figure. It has to reach or exceed 74. For us to put a new X, start a new column and put an X there. So we stay here at 73. And then the final day on this chart, or days on this chart, sees the market fall down to 71.48. And we're at 73, so we can add some figures to our chart. We can add 72 in there. We can't go lower than that to 71 because 71.48 is larger than 71. And we are also stuck here at 72 because 72.85 does not allow us to create a new full figure up to 73. All right, that's how we create a point and figure chart off of the intraday 60-minute hourly or hourly price swings. That should be pretty clear. It may take you going through it a couple of times to really understand it, but the basic idea is that we move, when we're using a one-point figure chart, we move a full point each time we go to chart a figure on the chart. If we don't move and you saw in here at some point we're 69.99, even though we were only 1/10 of the way, 1/10 or 1/100th, 1 penny away from 70, we could not put a full figure in at 70, and so we could only put that figure in at 69, and that was it. So a full figure is required, and if we already have a figure, when the market changes direction, if we already have a figure in that slot, we have to create a new column, and then we go from there, either up or down. I hope that's clear for you. That's basically it. It's fairly straightforward and fairly simple, tedious to do, certainly, but that's how we create point and figure charts. I want to cover some additional information using intraday versus daily data in constructing point and figure charts. This can be confusing to many people, and I want to be clear about it. When we construct a point and figure chart, we set the box size and the reversal. So a 1-point figure chart has a box size of 1 and a reversal of 1. This means that each figure on the point and figure chart represents 1 point, and that it requires a full point in price movement to reverse the column direction from up to down or from down to up. Now, whether we use daily data or 15-minute data to construct a one-point figure chart, we are still making a one-point figure chart. In other words, the box size and reversal are still 1 point. Using daily data or intraday data doesn't change that. The one-point figure chart is still a one-point figure chart, regardless whether it's built from daily data or intraday data. Now, what does change is the size of the horizontal formations and the accuracy of the projections we make from the point and figure charts. Okay, and therefore this is important. And this should make some sense. If we're using intraday data, we will pick up the intraday swings, which can often be hidden in the daily range of the high and the low. Using intraday data will show more of the accumulation and distribution that actually occurs in the markets, and therefore will make our projections of the accumulation or distribution more accurate. Let's take a look at an example. This is the one-point figure chart of Apple Corp. This chart is built from 60-minute data. Okay, now note from this chart we have an initial and a second phase projection that go to the initial conservative to 114, 115, or 115, 114, right? And the second phase going to 103, 104. All right. Let's see now what these look like on a one-point figure chart that uses daily data. So this is the same one-point figure chart of Apple Corp, but instead of using 60-minute data, we are building the chart from the daily data, the daily highs and lows. So it's still a one-point figure chart, just like the one-point figure chart built from the 60-minute data. It's just using daily data. But note the projections are not as accurate on the 60-minute as on the 60-minute chart. Now let's put both point and figure charts side by side. We'll see. But before we do, just note that our projections. How come that's not working? Our projections fall far short of what the 60-minute chart showed. Let's look at both. Okay, here they are side by side. Now, again, both charts are one-point figure charts. Each figure represents 1 point, and it requires the market to move a full point to change the direction of the column. So you can see that with both the expanded counts, the one-point figure chart built from the 60-minute data, this is the 60-minute right here, this is the 60-minute chart. This chart accurately predicted the extent of the down move. The one-point figure chart built from daily data, however, was not as accurate. It fell short in its projections. Okay? So the point is to use intraday data when you're creating point and figure charts. They will be more accurate because they are picking up the intraday price moves, thereby better reflecting the actual accumulation and the actual distribution that occurs in the horizontal formations. They're going to be more accurate, they're going to be more reliable, and those projections are going to give us a higher degree of confidence in them when we use intraday data. But again, they're both one-point figure charts. It's just the only difference is the data that's used, and commonsensically, the swings on the intraday are picked up when we use intraday data. They're not going to be picked up when we use daily data. So the intraday data point and figure charts are going to be more accurate than daily or higher time frame data.